Welcome everybody. I know some folks have been here for a couple minutes, a few more will come in, but we'll get started in the interest of time. My name is Mark Vanderzijl. Those of you who don't know me, I work for Johns Hopkins in the Technology Ventures office as the Associate Director of Startup Advancement. And it's my pleasure to introduce our panel today, who are the real interesting folks, and I'm just going to hopefully keep the conversation flowing. But this is the second of a four-part panel series that was actually envisioned by one of our panelists here, Dan Roche. The goal is to target some pre-company and early stage startup founders and to hear from firsthand people who've been there and done it themselves to hopefully avoid blind spots and some potential pitfalls. I'm going to do my best to try to monitor the chat and the Q&A, and we've got a few questions in advance, but hoping this can be a pretty organic conversation and we'll just see where it takes us. But I'd like to introduce the rest of the panel here. First, I'm just going alphabetical order in Ellington. I apologize to Kristen Valdez last time as a Vanderzijl. I'm sympathetic to people at the end of the alphabet, but we'll go with Jesse Christopher first, who's CEO and co-founder of Longeviti Neurosolutions. And then we've got Dan Roche, founder and board chair of Qualytics. And Dan is also a mentor in residence at JHTV. And then Ellington West, CEO and co-founder of Sonavi Labs. And then now what I learned last time, I'm gonna flip the order and give you each a chance to give your sort of elevator pitch or introduce your company, say a little bit about yourselves, and maybe correct my pronunciation if I put the emphasis on the wrong syllable, Ellington.
Mark, you knocked it out of the park. I'm Ellington West, CEO and co-founder of Sonavi Labs. We are a medical device and software company that's harnessing the power of artificial intelligence to transform the way we detect, diagnose, and manage respiratory diseases with our device, Felix. So basically, just think of the device like a stethoscope in that it listens to the sound of your lungs and body sounds. But instead of needing a physician present, the device and our AI does all that listening and makes those clinical informed decisions for the provider.
Since we're talking about launching companies today, when did you launch Sonavi Labs, or when do you think of its sort of official start date?
That's a good question. So we launched in October of 2017, and I consider that really, our very first day. We were ready to go. We've raised about $6.5 million to date, FDA approval. So we've accomplished a lot, I think, in a short period of time, and we're just kicking off a larger Series A round now. So we're very excited about that.
That's great. That's fantastic. Dan, how about if you try to introduce yourself and then the various hats that you wear? Let us know a bit more about who Dan Roche is.
Well, I think I've been a mentor in residence here for 8 or 9, maybe 10 years. I've kind of lost track. It's been a while. And been basically a serial entrepreneur my whole life, a number of software companies throughout the years, 1 or 2 healthcare companies as well, networking company. Had the good fortune of being able to take a couple of them public, which has been a lot of fun. My latest venture, Qualytics, is something that we started 2 years ago, and it is a data quality platform company. We use machine learning to build an inference engine to profile data that's either in flight or at rest in a database, data lake, data warehouse somewhere, and identify anomalies and help organizations improve their data quality. It's really important, especially as more and more companies become data-driven and are building AI and machine learning models. Quite often, one of the first things they'll tell you is that their data is trash or has a lot of garbage in it or a lot of problems. And so we're there to try to, be the plumbers, help clean up the data before they start building AI and ML models, as well as they start making big decisions off their dashboards. And we've seen customers make mistakes just because the data wasn't what they thought it was. So that's my latest venture, and we started 2 years ago. We've raised $2 million, and we actually are expecting a term sheet this week for our next round as well, our first priced round. So
great. Thank you, Dan. I'm hoping today you'll be able to share your sort of firsthand experiences as well as those where you've helped kind of mentor and guide other startup founders. And last but not least, Jesse Christopher, let's hear about you and Longevity Neurosolutions.
Hey, Mark, thanks for having me. And, CEO, co-founder, just because I hired myself, not by design. I ran the East Coast for Stryker from the neck up, CMF, so craniomaxillofacial. So for about 20 years, I was able to see surgeries and run teams that, for Stryker is a Fortune 300 company, sell implants for everything from neurofacial reconstruction. What was interesting, though, is to see all the best practices in different disciplines, and really the business opportunity of pulling some of those best practices together. And so in 2016, I started Longevity Neurosolutions, pulling together some of the best practices, focusing on where are we going to put the technology of tomorrow. To date, we now have several products through the FDA approval process. We have had over 1,000 implants implanted in neuro patients across the country and internationally. We've got the only cranioplasty ever done on a ship for the U.S. military. That was pretty cool. But what's really exciting is lately these platform solutions that we've created for where do we implant things and how do we safely implant technology have started spinning out this great need of data analytics. So when Dan was talking about that, it's really funny. We need to talk after this. The company now is really focused on what, neuroscience is all about, data. And so the problems that we're uncovering today and dealing with in 2022 were totally, I shouldn't say unpredictable. They weren't forecasted for our implantable company back in 2016, at least not this soon. And I can talk about why, but it's been a lot of fun. I'll just say through the pandemic and, everything else that can go wrong, we've learned a lot.
That's great. It's funny. I was talking to one of our law firm sponsors, a corporate attorney, a few years ago, and he said a lot of startups who think they're life science companies find out they're data companies. So it'll be interesting to see how you three sort of touch upon that. What we've tried to do over these 4 panels, we had one already, there'll be 2 more in May and June, is to have diverse backgrounds, different technologies, stage of founders, companies have been at it for a couple of years, some med device, some digital, some therapeutic, diagnostic, et cetera. But it's interesting to hear how even, how you describe longevity or how Ellington describes Sonavi, because, some people would say medical device, some people would say machine learning or AI. So it'll be interesting to hear how you've sort of navigated those different verticals within the same company even. And
that vernacular, Mark, might determine how much money you raise.
And that's true. And I had the pleasure of seeing your first space. Some of you may have heard at the very beginning before we officially started. Longevity's headquarters have been up in the Hunt Valley area, just north of Baltimore. And I think of it's a really cool space. It's kind of a mix of like laboratory, comic book store, and like an auto body shop, right? There's a lot of cool stuff up there.
We have a couple of engineers that in their spare time have made fully functional wearable Ironman outfits. And they do good. They go to hospitals as Iron Man, and the eyes light up. And we've got some pretty cool 3D printers. But I mean, it's clearly not what we do.
No, it's awesome though. So we focused the first session on sort of pre-company planning, and what does it take to be a startup CEO? What is that role and that skill set? Or what's a day-to-day life for a startup founder? Today, we wanted to focus a bit more on the progression of that. Like you've done a lot of the pre-planning and now you're ready to go. You're ready to launch this company. And what does that mean? And so I might start with Dan, since this was your idea. Can you tell us more what your thoughts are on the operating plan and maybe some of the benefits on keeping it simpler?
Yeah, so the operating plan, having an operating plan is critical. Whether you share it or not, doesn't matter. But if you're going to raise any kind of money, you will probably fall back on it. I mean, even as I judge all of the different grant things that Mark and other people at Hopkins have thrown at me, if you've had this operating plan, it helps you with a lot of the questions that are quite frankly in that. But the number one job, start out with the number one job of the CEO. The number one job of any CEO is to make sure that the company has the resources it needs to thrive and survive. That is job one. That is your job that nobody else can take responsibility for you, which usually means money. You need to make sure that the company has the money that it needs. to execute whatever your plan is. Therefore, to even answer that question for yourself, you need a little bit of a plan, a basic operating plan to know how much money you need to raise. So for example, if you just take just a simple situation, when you're thinking about your operating plan, and basically what the external community is going to want to hear from you, whether you're going for non-dilutive funding and grants or you're going for investor funding, is they want to hear, okay, you're early stage, you're very young, you've got a great, cool idea. What are your milestones? So think in terms of milestones. What are the top 3, 4, 5 key milestones that you need to accomplish? I need to identify 5 customers or prospects who will buy into our vision and be a sounding board, number 1. Number 2, I need to build an MVP. Number 2, I want to deploy that MVP. Number 3, deploy that MVP to 6 customers. I need to get feedback, and then I need to get a customer to pay. So if those are your 5 milestones, build a simple operating plan that's a 12-month plan that's going to require, the CEO, a CTO, 2 engineering resources, and then model that out for 12 months. Other expenses that you're going to have, I'm sure that Ellington and Jesse can talk more to the medical field in terms of planning for your filings and registrations and trials and exposures and things that you're going to need to do in clinic. But lay all that out and then throw numbers at it. What is the money that I need to raise? And then that allows you as the CEO to get back to your job 1, which is to get those resources and put them in place. Chase as much non-dilutive funding as you can. And then if you think you're ready, and which, I'm sure we can have a chance to talk about, is, when and how do I go actually think about raising money? So that's what I think of with an operating, and it doesn't need to be big. I mean, 12, 14 columns, spreadsheet, with 15, 20 rows, lay it out month by month by month, just simple. Keep it as simple as you can, and then make sure when you're hitting those particular milestones. That is the way I coach every single organization I work with to think of, and it works very well until the organization gets bigger and more sophisticated in its budgeting and plan.
That's great. Thanks, Dan. I think when we talk to people about starting a company, we say, why do you want to start a startup? For one, and then do you have a plan? Right. And it seems pretty obvious after you pointed out, but have you made a plan and identified the people to execute on your plan? And we're going to talk a bit more about people here in a few moments, but that's interesting. You must have a plan, right? Otherwise you just have an idea and you don't have a company, right? Interesting. Ellington, can you speak about, your take on the operating plan and maybe even some of the feedback you've gotten on it, right? I've seen a lot of what I might say are more academic plans where, I went to business school more than once, and everybody's got their sort of 5-year projections, and it's always this amazing hockey stick graph that just by year 5 we'll have everything figured out and all this amazing revenue and milestones achieved. So maybe talk to me about how you do that, bucketing the milestones and what the feedback's been on your versions of an operating plan.
Yes, Mark, let's talk about it, because for me, I think that there's a really big difference too between like a strategic plan and your operating plan. So I bring in my team and we do a huge strategy session where I bring everyone in from every sector. We're a small team, but it's still from every sector, and everyone's really evaluating, how do we dream big? What do we want to see? What's possible? Because I always want my team thinking about what's next, right? But then we boil it down and we have to get tactical. And that's the difference. My operating plan allows me to know what each person on my team is doing, what their objectives are, when they're going to execute, and why we've prioritized it as a team. I'm never guessing who's on first. And that's so important. And it was important to implement this for my team early, because as we scale, there's going to be so much happening, new people involved, that we always need a compass and we always need to know what we're running towards and what tools and resources we have. So for me, it usually goes strategic planning, operational planning, and then budget. budget, because I can just then refer back and really see again, based on those priorities, what we need to be doing and what we need to allocate those funds for. Now, for me, it was really funny because when I first started, I was right there, Mark, in that 5-year plan where I was like, we'll be at 250 million by like, come on, stop it. No, you won't. Pause. Let's think about this incrementally. And really then it allows you, if you have a plan that have goals that are achievable and those milestones that Dan was talking about, if you have them in place, you can be so proud and celebrate the wins, and it keeps you going, because this road is longer than you think it is. And you have to have those moments within the journey where you're reaffirming that you're on the right path. So I think that those set milestones is what Dan was saying, but making sure that there's also time associated with it, right? He was breaking it down into months, deliverables. And to me, that's something that's available to my entire team on Teams or in Monday, which we use for project management. And it just keeps us all tight, lock in step, and ready to move forward.
That's great. I like that operating plan versus strategic plan. I think it's great to be ambitious, but it's also important to have realistic and achievable milestones that you can celebrate along the way. Jesse, I'd be interested to hear your thoughts on the operating plan, and especially as you sort of move from, like you said, a very big organization like Stryker into being the CEO of a lean new startup.
Yeah, I really like what Ellington said too. I'm going to borrow that. I feel like that's our cadence, but we actually, we really have more of an living operating plan, and it's more of our calendar. We have projects for, R&D and for specific projects, but for our executive team, there's a cadence that we all subscribe to at the beginning of the year. Much like Ellington, we'll have cadence, and every business unit knows the expectations for the whole year. So right now, when I look up here, I can see every day of the year, every major event for the company, and I also can see by a color coding, each day of every week that we're having our team meeting and who's presenting. So yellow is finance, green is sales, etc. So everybody has this. Not everybody has it on their wall because I'm ridiculous, but as a CEO, it's really helpful to be this organized. Whatever your system is, whether it's a color coded calendar, being able to communicate that to your team is critical. So I don't want to repeat what Dan and Ellington said, but I famously before our annual meetings with the executive team had 2 quotes. If you fail to plan, you plan to fail. And then right below that is everybody has a plan until they get punched in the face. These are both true. And we don't live in a world of black and white. So you're going to make a plan. It's going to get blown up. You're going to make it again. And that brings up another one of my favorite quotes by Ray Lewis. And this is last year they won the Super Bowl. Embrace the grind. Like Ellington said, it is a long journey. And, you need to start with the first question that Mark said, why you? Why do you want to do it? You might have a great idea. Do you really want to run a business? Because those are 2 different things. And, you really need to paint for yourself first. What is the lifestyle that you want to live? Because to Dan's point, if you don't want to raise money all the time, do not subscribe yourself to be the CEO. You can be president, you can be owner, you can be anything, you can be, whatever you want, but you don't have to be CEO. That's the CEO's job. And it is a grind. Anyway.
That's great. I'm glad you brought up that Mike Tyson quote about everyone has a plan to get punched in the face. I was going to ask your 3-year take on, how do you plan for something that's so volatile and speculative and unpredictable?
Well, I'll just say from experience, well, that brings up another quote by Oscar Wilde. Experience is the name we give our mistakes. You need to create an environment where people are not afraid to make mistakes, that they know the stakes. So when they do make a mistake, it's not repeated. And that you also create an environment where, if mistakes are going to be made, that, it's in a bubble. So when we're developing devices, of course, there's prototyping phases and all these stages before that, but create that, for your team too. When you onboard someone or promote them, or if it's a new company and there's no norms yet, create an environment where it's okay to make mistakes. Hey, how do you communicate? Do you like to text? Do you like to email? How do we not cross paths on some important communication? So when that happens, when our first, real obstacle came as a company, we hired a sales force. And as soon as we hired them and trained them and invested all this great investor money, we lost our sterilization. So our main product, we could not sell. It sucked. So we pivoted, we had another product we, focused on. But what was interesting is this company was not prepared to, all of a sudden screech to a halt. So what was fascinating is when the pandemic happened a year later, we were prepared. We had done this before. And so, there was a small example of that before the sterilization, but I only say those three examples for our company just because at the very beginning, if we start, creating this environment where we can make mistakes, by the time, external things are coming, we're prepared. We've already learned enough about ourselves, how we fight amongst each other, how we work through problems, how we communicate effectively. So when a pandemic comes, I got to be honest, we were all looking around the room saying, all right, we'll weather this. We'll figure it out. It was stressful, but you need to build an environment that's uncomfortable in a positive way. People should not be sitting on their butts. They should be uncomfortable. And if you haven't been tested by, your own, by something unforced, then, run some drills. Sorry, I'm talking about Ellington. That probably has a lot of great input.
No, I was just fully agreeing. It was a good thing that I was on mute because I was just saying yes and absolutely. I think that it's the power of the pivot, right? Like I think that as CEOs and entrepreneurs, we live by that. But I couldn't agree more about creating a safe environment for your team to succeed and to fail. Because when they can trust you enough to fail in front of you, with you, see you make mistakes, it allows there to be a space where we can collaborate to fix the problem. I also think that we operate with never having one thing, all of our eggs in one basket. And I can't emphasize that enough of like, yes, you have a plan A, but what does your C, B, and D look like? For us, for example, we're dealing with incredible supply chain issues, right? Where we can't get semiconductors at all because Ford has decided that they're a priority. I'm over it, but we're working through it, right? And so for us, it's okay, then what kind of software vertical can we look at? How else can we still participate in our space, still obtain market share while not being able to actually have a large chunk of our physical product, right? And we pulled everyone in. It's also about your resources. Who do you have? Who can you leverage? What do you have in your war chest that's always ready and prepared? And I just think that the first line of defense, though, is your team and having them mentally prepared. And I love the idea of running drills. Like we've been through enough real-time issues to not have to run them, but I love that idea to callus and get that thick skin ready to roll,
Dan, any thoughts?
I would just reiterate, I think what Ellington and Jess really said. I mean, and we're going to get to it a little bit more when you start talking about roles, but building, the number two job of the CEO is building and managing the team. And it really is all about the team at the end of the day, because trust me, you're not as good as you think you are. And, it's all about your team. And then what are the things that you're looking at that are going to determine when, where, and how you're going to pivot? I think Jess said it, you're going to get hit in the face. You're going to get hit in the face and you're going to pivot. And are you paying attention? Do you know you got hit in the face? This is probably the worst thing that I've seen with organizations, is they didn't even know they got hit in the face and that they needed to pivot, and they just kept chunking down that road. So you have your ear to the ground in the right places. Some of those unknown unknowns that I see with some of the early stage organizations, and they go a little too far down the road before they pivot. I've seen that a few times. So those are tough things to manage. But on the flip side, that's what makes this the most fun anybody could ever have doing anything on the planet, in my opinion.
And Dan, I often think about the plan, the people, and then the money, right? And without those three things, you probably don't have a startup yet. How do you talk to inventors and startup founders about building that founder team, especially if in our world at the university, a lot of the inventors will not end up being the CEO. Like, so how do you talk to people about building that team and the involvement of sort of technical folks, business people, and how do you think about that founder team?
Well, I think about it right when I'm building that operating plan. Once again, the usefulness of that operating plan. You're laying out your expenses. I'm not talking about hockey stick. My operating plan for the first 12, 18 months of an early stage startup does not have any revenue in it. I assume there's no revenue. It's just all expenses. So what are my expenses? My number of expenses are my people. And if I know what my milestones are, then I really have to, and I work with my team that I've surrounded my people with, that have helped build the organization, that are part of the startup. I mean, the inventors, the co-founders, the academics, whoever it is, I bring as, and I try to say, what are the roles we need to hit these milestones. Okay, what are the 1, 2, 3, 5, 12 people that we need to hit milestones 1, 2, 3, 4, and 5 in this particular time frame, and I build them into the operating plan. Once you kind of have those roles, now you're starting to figure out what that team is going to be, and this is where the CEO, needs to be a great salesperson, needs to be selling to the team all the time. They need to be selling to investors. They need to be selling, but you're selling this vision, you're bringing this team together, you're identifying those roles. Once you've got that operating plan in place and you've got good agreement, you feel really good about it, and the team you need to get you through those milestones. Well, now, and the value of those roles, then you can start thinking a little bit about, because some of the inventors I know that we have coming out of academia, they don't take active roles in organizations, they take passive roles. So you need to think the difference between an active role and a passive role. And then, there are industry, standards, so to speak, or philosophies, and there's multiple of them, they're not the same, on how to begin to think about how to bring that team together. If you don't have any resources and you're looking at mostly compensating people with equity to get the team off the ground, there are ways to go about that, and there are things out there that are addressed, but without knowing the roles, it's really difficult to begin to have those conversations. Once you have that, then you move into a huge trust building world where you need to be having very frank, open conversations with each other on the roles that people are going to play and the value of those roles in this organization, short term and long term. And then you can begin, in my opinion, to have deeper conversations about how the organization would get launched.
Jesse and Ellington, I'm wondering if you guys can weigh in. And did you nominate yourselves as the CEO? Did you identify, I want to be the person to run this company? And then if so, how did you figure out who else to put around you to complement your abilities?
So, I'd love to, not to jump in, Ellington, but, you said some great things, Dan. I just want to piggyback while they're fresh, but, know your strengths. More importantly, know your weaknesses. If you're getting into entrepreneurship, maybe you've got a level of competence or confidence or experience that helps you start on the 50 in some area. Odds are very slim that you're that capable in everything, right? So to Dan's point, you need to get real honest with yourself before you drag anybody into this, take their money, hire them, and have anybody bet on you. You better know yourself, and you better know your weaknesses. So if you don't, there's a lot of great tools. First of all, just ask your wife if you're married. If not, or your husband. But really ask the people that you trust. Hey, what are the things that you think are going to hold me back or hold this company back? And if going the next level, one of the things I did at Stryker was I utilized strength finders. It was a great tool, and I used to argue with the Gallup company all the time. Right? Here I am, a neuroscience guy, and I believe in the sciences, but also as a CEO and a little bit more abstracted mind, like to believe in free will, and you can't predict everything, right? But you can take these strength finders, and not only do they tell you more about the individual, where they really come into play is you can start to see how your team will come into work together. Some of these companies like Gallup will help you hire someone. But more importantly, they'll tell you, if you're going to end up firing this person, how are you going to end up, what's going to cause this person not to work with your team? Or when you have disagreements, how are you guys more likely to, work that out? Are you going to, have it out in front of a whole group, or is it going to be passive aggressive? Or, is this person an introvert versus extrovert? That's real basic, but there are much more deeper tools there. You can find out about yourself. Hey, I'm a learner. I'm going to spend all day learning about this so much that I'm just going to waste everybody's time. Or, hey, I'm an achiever. I'm going to jump in and I'm just spend money and make mistakes. Know yourself. Then exactly to what Dan said, get real honest with yourself, revisit that, ask around, and then start hiring. So when you start building that team, you need to understand where you're headed along with your operating plan. You need to set expectations from day one, not just about their income, but what is it? Paint the picture. And this is an exercise that I can't emphasize enough for yourself and with it. You're going to get up at what time? I'm going to expect you to be available these times. this is the way the company communicates. We have these, meetings, or, this is kind of how when we all get together, whatever it is that's important to you, it needs to be explained up front, because there are no shortcuts. Anything that you don't address will inevitably come up and be twice as hard to deal with in the past or in the future. So set expectations for the job, comp, communication. We already touched on that, time expectations. And then, like Dan also said, you got to start building trust. And that is the most important thing. So, there's a lot of mentors out there that can help you get to that stage. You got an idea, now you got funding, now you got a team. I mean, you see that all day long. That's where people start to fail. Okay. You got to build trust from day one. And that is a simple formula. It's production over time. Every single person has to produce. So if you set those expectations when you hire them, you can start scoring them from day one. And as a team, you set the expectations that we're going to revisit all of our, job responsibilities on a quarterly basis or a monthly basis. It's not going to be a surprise when we're all meeting and Jesse's not, pulling his weight. And so after 2 quarters, when our investors are asking why we're behind, well, the whole team understands that. And by the way, I'm not trying to point fingers at Jesse, but we need to understand what does this business unit need? Where do we miss? But you can't afford to waste that time. And as you start producing, you build trust. So, Ellington and Dan's business unit, you build a lot of trust in it. And so, you give them more resources, but it's all about that, knowing your strengths and your weaknesses from the beginning, revisiting it, hiring a team, revisiting it, setting expectations, revisiting it. And that's then how you lead to a culture.
That's great. We're in the 4th session, we're actually going to focus a lot on scaling, and part of that will be performance metrics and reviews, and how do you bring people into your culture, and importantly, how do you let people go that aren't performing or aren't being an asset, and how do you document those things? So that you set the stage for that quite nicely there, Jesse. Ellington, how have you approached building out the team, and maybe, the scientific inventors, the early hires, elaborate on that a bit?
Absolutely. For me, it was a very different experience. I'm a first-time founder, so I didn't have this arsenal, or I didn't know exactly what I was doing, but what I did know was that I needed this operating plan, right? That's just kind of where I started, because something that I knew I needed to do was understand what I needed, understand my strengths. So I absolutely did a strengths finder, and that comes from my old sales days. I was like, let's just reevaluate who we are and where we are and what we're capable of. Then I really kind of reverse engineered from my operating plan and said, what do I need, to Dan's point, to actually achieve these goals? And the challenging part was that I didn't have any money at the time, right? So I had to be the best salesperson in the world. And what I had to spend the most time doing was crafting a story that would get people excited about taking this giant risk, because I didn't even have the capital to say, I'll pay you, fair market value. I had to be so clear on what I wanted, even the things that I didn't know. I had to be honest and be able to articulate so that I could really get people excited to kind of drink the Kool-Aid and join me on this adventure. And so that was really the most basic foundational step that I needed to take. And then it became, the next layer was really about credibility, right? As a first-time founder, who do I need behind me to be taken seriously in this space? And that was really like this interdisciplinary from the scientific community, the business community, and the medical community, right? And so I knew that I had to hit those 3 targets in order to be a really well-rounded team, to at least just be able to be invited to sit down in the room, right? And so that was really the very foundational piece of how I started the team.
And you guys don't have to divulge any specifics, obviously, but how do you think about sort of equity as a compensation component, particularly when you don't have money? Or in Dan's, you mentioned active versus passive people, right? So does that weigh into? We've talked internally at JHTV about, up to this point, what has been everyone's involvement in the technology and the development, and what is your involvement going forward? And to think of those 2 things together when you're sort of divvying up the pie.
If I could just say real quick, well, go ahead, Dan. I mean, but I take this really, it's funny. I mean, I say this even in the interview process. You can't possibly know. I mean, you're taking a risk, and the only thing you can do is perform over time. And so the one thing you can do as a CEO is hedge against that. There are vehicles, but I mean, just overarchingly, don't give away too much equity. Really covet that. Your investors want you to, your future you want you to. The other thing too is you can create a different class of equity. One of the best things that I did, and I made mistakes. I mean, I personally gave equity away when it was just me unemployed making no money, because like Ellington said, time is you feel pressure times two, and it's unhealthy. It can make you make rash decisions and bring people in your team maybe too prematurely. But you can create dilutive tools that allow you to say, okay, if I made a mistake with this one person, but in 2 years I've got another person, then maybe there's this class of shares that dilute people that aren't a part of the team anymore. And listen, you got to set expectations. It's got to be clear, but there's no hedging against it, but there are tools that have relating specifically to equity you can use.
I would just agree with everything that Jesse said, but I would back up the train just a little bit more. For one of the things that I definitely find for early stage companies, early stage founders, early stage CEOs that haven't been around the block on it more is cap table management, cap table planning, short and long term. I mean, an initial cap table versus what a cap table is going to look like after a seed round, a series A, series B, series C, without even getting into those specifics, just thinking about it in the initial, because we don't think we have time to address all that other phase stuff, is typically, you'll see that the founders, the CEO, and this is just typical, this changes quite a bit. They usually take about 40% of the cap table, somewhere in there. And then about another 40% is going to go to early stage employees, because you need that tool, because you're not going to be able to pay market salaries. You're going to ask people to make sacrifices, and you're going to try to, typically if you're trying to get early stage, you're trying to get something on the ground, you don't have a lot of cash, you're asking people to make sacrifices, and you're making it up to them to drink the Kool-Aid, to believe in you, as Ellington said, and to believe in the vision, and to believe that equity is going to be 2 + 2 = 45. And then you need probably set about 20% in an option pool. And I agree wholeheartedly with Jesse. All those elements can be structured with different tool sets of different vesting schedules, different classes, things along those lines. Before you get too complicated in that, though, just realize that it is a very important tool, and there's a lot of good information available out there that you should, as the incoming CEO, go get up to speed on. It's a side job that you need to go. You need to go get a small mini education. Go out to Y Combinator. Their website has a bunch of stuff, and there's different philosophies. So, the Y Combinator world, I don't know, they're in California, they're in the West Coast, all founders are treated equal. It's very much a thing. But then up in Boston, okay, what's the role? What's the value of that role? You get 4%, you're passive, you're active, you get 3%, you get 9% because your role is only worth it. So there's different philosophies, don't get me wrong, but you and your team will come to bear, but think about it as a key tool, short and long term, that you're going to have. But typically, there's no ifs, ands, or buts. The startup founding CEO that gets the deal off the ground, my experience is in the 30 to 60% range. And then you're using the rest, whether people are coming in as founders with you initially at first or not. They may get founding shares, they may not. And then depending on, I go back to that cap table and those other roles that you need to get those initial milestones done. You need to value those. You need to think about how much money you can and can't raise, where it's going to come from, how you'll be able to compensate them. And then those are your tools for building that team. And you need to get creative in doing that. And I think that's likewise, we're having good mentors and advisors to help you with your specific situation, because they're also different. I'm trying to be as generic as possible, but they're also different. That I just tried to paint a bigger, a semblance of a picture there. But I guess maybe the biggest thing I would encourage for the early stage companies is, hey, treat it as a weekend mission. I got to go get educated on cap table management, short term, long term, and how does that progress? Because if it's also a huge area where I see mismanagement of expectations early on that creates all the angst 6, 9, 12 months. If you get that wrong early and you set expectations improperly with some of your founders and your early teams, then boom, you guys have a big fight 9, 12 months later, and your culture goes to crap. You had a great idea, but your team collapses. that ain't good. That's where I go back to the trust thing that I mentioned. So I don't know, just some early thoughts there, I guess, is think of it as an important area for the CEO to think about.
Yeah, I'll just piggyback off of that, Dan, because I think it's just so spot on. I always think about my team as my most valuable asset. And I ask myself, what equity split can maximize the success of my team? So I'm looking at people very differently, understanding what their motivations are, but always protecting us first. So our vesting and cliff schedule is insane. It's like Fort Knox over here. It's going to take a lot of time for you to get what you think you deserve, but it's trust, right? And it goes both ways. So for me, I know what I'm willing to give up because I'm giving a part of my company to, like, it's about trust. It's so important. And you have no idea. People will sell you and be the best thing that you could have ever asked for. And then 6 months later, they're the worst person and you can't wait to get them off of your team. But to Jesse's point about protective vehicles and being aware also, layering in some employee stock option plans that can be really useful and helpful. So there's just a lot of things to layer in because you want your team to feel empowered. And to me, that was my greatest tool in navigating this space really pre-capital, right? So for me, it was one of the best tools that we had, but it is a very slippery slope. And I highly recommend not just taking as many courses as you can, but also leaning into your attorneys if you have them to really review and create these plans. I think that that's probably one of the best investments that you can make with limited funding is to really invest in a strong equity plan, ESOP plan, and understand really where you stand to your cap table, because it's hard to interpret. And I needed help and I needed support. And I'm not afraid to admit that, because now I feel that we're so well positioned to take on new employees, but I know that my founders and my founding team is also happy and that they're here for the long run. So
that's great.
Can I add just real quick? Can I add to that? Because you guys hit on some great points. I mean, I'd be remiss if anybody didn't learn the hard way, and I save my breath, but a couple of things you just don't know. To Ellington's point, beware of people looking for a startup environment. Unless you want to be a perpetual startup, that's not who you're looking for. And so you don't know who you're going to hire and give equity to. People looking for a startup environment, beware. That's all I'm going to say. Somebody asked you questions about what actual form of equity, and that's a great question. Your employees and a lot of people you're going to hire aren't going to know this, but they need to know that if you give them straight equity and there's any value, they have to pay taxes immediately on that. There is an exchange of value. Okay. Whereas you give them stock options or profit interest units, depending on what kind of corporations you are, they get the upside and no downside. And that's really sellable too. You're like, well, you're coming in today, so this marks the time you're coming into the company. I already founded it, or we founded it, or whoever. And from here on, you get a participation. So for small companies, it's profits interest units. For larger companies, stock options. But then to Ellington's point, within that, you get a lot of, vesting schedules and Dan, there's a lot of tweaks. I like what Dan said. Research it, and then, because it really is different. You can create any type of company you want. And back to the very first question that Mark asked was why? Why are you in this, and get to that baseline? What kind of environment you creating, company you're creating, and that'll help you create also your modus operandi on how you delegate your equity.
That's great. Jesse, I knew you were good at sales, but you're doing my job for me. You're kind of plugging our third session. So it's great. So next section, we're going to talk about important nuts and bolts, and we're going to have Howard Schwartz from DLA Piper's corporate practice division, Robert Broe from Deloitte, and someone Dan will know well, Sebastian Sager from Emoca Health. So we're going to talk about a lot of those sort of foundational things and the things that you put in place to have your company set up the right way. So it's like you're plugging for us. It's great.
I hope they all recommend Carta, because that was a great tool. And it's worth every penny.
I was going to ask that for cap table management. That's one I'm most familiar with.
Our life changed 3 years ago when we went to it. I mean, I highly recommend any new company start from day one.
It's free to start with until you've raised $1 million. It's free for managing your cap table. I guess the only other, if I can interject one more thing to really follow up on what Ellington was saying, when you think about as the CEO, as you're building your team and you're looking at your tools to build your team, really just to emphasize one of the things that she said, each individual you bring onto your team is just that. It's an individual. They've got different life circumstances. They have different motivations. So, the sacrifices they are willing to make and or can make can be very different. So some people will really value equity and some people won't. And you as the CEO need to understand that, learn that, and manage that properly. And then likewise, think about the impact that how you treat equity going forward in your organization affects the overall culture of the organization. I see companies that are very, very stingy with their equity. And then I see companies that give anybody that walks in the door 1,000 options right out of the gate, and no matter what. And despite the fact that half of them don't even know what it is. So it can go really both ways. So I just, throw that out there, that it's really important to you as the, this is one of your tools. So if you're going to be the CEO of this business, this is one of your key tools. So I'll just reemphasize what I said before: go spend a weekend and get up to speed.
So this clearly is something we could spend a lot of time talking about, but one other main bullet point on what was sort of advertised for today was about raising capital. So I might try to pivot this conversation, and it'll involve a bit of the team as well, because when we talk about advisory board and who comes on as you're raising capital, I think it's important. So, you mentioned earlier, I think Dan or maybe Ellington or all of you, non-dilutive funding is wonderful and plays a great role. At some point, typically people will take on equity investors. So how do you determine when is the right time to go after investors, and what type of investors do you look for? And anyone can volunteer to be first of that. Last time we talked a bit about a lead investor.
I'll say one point, because I'm sure we got a lot of input, and I'll shut up because I could go on forever. But one of the things I completely underappreciated, and this is start from this: know who you're talking to. Okay, and every VC is not the same. Every private, they're all different. You have to appreciate why they came to meet with you, what got them out of bed to meet with you, to talk to you. What does it say online about why they're investing, and use those words, back to them, or find out, hey, we're not a good match. If they're looking to invest and turn a company around in 4 years and they're advertising that all the way through, this isn't a long-term company for you to build. This is, this isn't a match. Or conversely, if you're looking to build a new industry and they're looking to turn around, you need to understand what their pivots are or what their constraints are. They've advertised those to their investors. Every group or investor has an expectation of what that exit looks like. Ask them before you pitch your company, before you do anything. Ask a million questions about, when is your call? How big is your fund? What kind of things do you like to invest in? Who do you invest in? Who have you invested in? Why? What size of checks do you normally write? What kind of return are you looking for them? What other constraints do you put on your money? You get comfortable asking all those questions before you start talking about your company. Maybe give them a quick pitch, because you have every right to. Time is so precious for you, more so than them, because you're all in and you're doing a lot more jobs with your company than they are. So you feel free to, in 5 minutes, ask those questions, do your research, and get to know them. Don't waste your time pitching your company for an hour if it's not a good fit or you didn't hear what you wanted to.
I couldn't agree more. I think that diligence on the front end is absolutely, as a CEO, your responsibility to know your audience, know who you're talking to, and to really understand their motivations. The best investors that I have are the ones that I felt comfortable with from day one, because you want the investor who's going to support you when things are great, but you really want the investor who's going to roll up their sleeves and be there right with you if things aren't going well. The most important thing, and it comes back to what Dan said at the very beginning, is trust. You're building your team, you're expanding your vision, and you need to think about the team that you want to run with you to be successful. You go back and you check that operating plan to really understand how much you need to raise and when. Always give yourself more time and double the money. I swear, I believe that to be true, because you learn, that things always take twice as long and they're twice as expensive. And for us, as we were really navigating this, it was so important to lean on our network. So I was very thoughtful in the people that I included in my founding team, because they then became an extension of their network, right? So that when we were doing friends and family, we were able to tap into all of these resources. So it's not just about being strategically aligned with the folks that can get the job done that you've listed on that operating plan, but also who has powerful networks, who's inspired, and who has access to capital, because it does take a village when you get to that point. And for us, we were very successful also also in non-dilutive funding, with over $3 million from NIH and NSF. That was such also a wonderful proof point as we then went to go raise capital, right? That we had these major institutions supporting us. And so I just encourage always running parallel paths if that's an option for non-dilutive funding, and to make sure that you just take the time, like Jesse said, to really get to know these people. Because to me, it's crazy to, have a deal sourced in a week and then closed by the end of the month. Like that's if this is a price round, I think that's completely dangerous. I think that if you're looking at friends and family, it's a convertible note, it's a safe, there's a little bit more flexibility there for the founder, but I really believe that you have to do your diligence, ask. And feel free to talk to some of the founders that they're supporting or some of their portfolio companies when you really get boiled down to that point, because what you're accepting, they're now your boss. That's really how I think about it, right? Is that everything changes, the dynamic changes, and you now have someone to answer to. So you better make sure that they're adding value and that you feel comfortable to really have them as a part of your team.
That was Ellington, so well said. And somebody asked something and you just led right into it. There's a question about our chairman, and it goes right to what you're saying. Vet these people out and get to know them, because ideally you're getting more than just their money, you're getting their network. And in some cases you can get, you should be getting and acquiring board members that also help you adjust those gap. I mean, if in one stone you get financing, expertise, and a board member that brings in other people, that's who you're looking for, right? And everybody's industry is different. So, we benefited from the same thing. I was looking at, investors and frankly, embarrassingly, thank God they came back to us later, because it was a great cause. But one of the groups that we really wanted to invest in and was our first pitch offered us money, and it was great. Unfortunately, there was a small string attached, and and we had filled our first round, and we got a call from a group that was a little late, but they offered a little bit more and didn't kind of have strings attached, so to speak. So we made a very difficult decision to say, okay, you were the first ones to commit, but how do we say this? We're actually going to take this other money. Now, it's difficult, but that honesty bode well for both parties. Today, they're both investors, and I think both proud of it. But we got much more expertise out of that and setting the bar, extremely high on what we're willing, the expectations we're willing to set, the honesty where we operate within, and the fact that we're not just looking for money.
Yeah, I would echo that as well. I think that typically, I mean, what Jesse just said there is so valuable to an early stage CEO. I think that investors are a lot more than money. I mean, they bring typically bring their master networks, because that's the business they're in. So their networks are incredible. And when you bring a good solid VC, you're getting somebody that has a lot of experience having watched other companies grow and fail. So they've got tons of stories to share with you in all the time, and help you see some of the unknown unknowns that you don't know. They have networks of other advisors they can call quickly and put people in front of you if you have something that you just need to learn about quickly. They have access to lots of talent that they've worked with over the years, or have in other companies that have outgrown some of their other companies, or different things like that they can put in front of you. Likewise, they can put you in front of a lot of potential customers. And then on top of that, you also have this weird world in the, if we're talking more later stage investing, where, if you say you got a VC out of Virginia or Baltimore or Atlanta to invest in you in round one, and then round two, you get one out of Boston that has this kind of a name, and then eventually you can get somebody out of Silicon Valley. Well, that in its own right is giving you all these valuation bumps and all this incredible credibility bumps. So there's literally a whole plan you can have along those lines. But if we were to back up, I think, to Mark's original question, one of them was, how do you know when to go raise money? I think that was one of the first questions you asked. And, that's I think, as Ellington was saying, well, not everybody is blessed with the ability to raise lots of non-dilutive funding and get lots of grants that help them build their product or build their thing and test it out and that sort of stuff. Eventually, you kind of run out of that. And if you really have a great operating plan, and if you really put a good set of a team together, you need to have a good team, because the number one thing a sophisticated investor will look at is your team. Well, then you're going to start sharing that idea and that vision and that presentation, whether you have an MVP or not, with the angel community. And, and that's where JHTV comes in and the other mentors come in and stuff. They're going to start introducing you to some of the angels, and they're going to listen to your story. And, you're going to try to raise that first 350, 500,000, 750,000, whatever it's going to be, that's going to be that first round to kind of get you off the ground from the unsophisticated investor, or somewhat sophisticated. Some of them are pretty sophisticated, but, and it's going to be a safe note. It's going to be an unpriced round. The safe note, you don't know what a safe note is. The Y Combinator safe note is pretty much accepted in the industry, with one small exception. The one they publish is a pre-money valuation, which is a bad idea because it has infinite dilution if you keep raising on it. So you really want to go with a post one, but I won't get into that. But really it's just that the safe note is typically the first thing that's going to get you off the ground. And then, but also realize that if you're working with angels, this is where the whole domino effect comes in with that investor community. Rely on them, treat them as like advisors, help build your board of advisors as well, and put these questions in front of them, because these are probably the people that are going to do the first introductions for you to your first set of potential VCs, where are going to be some real learning experiences for you. That's where you're going to get punched in the face a bunch. And, but it also gets the domino going, and you're going to learn and work from it and pivot a little bit, and then you're going to try to work your way to an angel seed round, to a seed round, to a Series A round, things along those lines. But to get it off the ground, everything that I think Mark has teed up for us to talk about, that operating plan, the team, getting that in place, building that vision, getting that sort of stuff, then you're ready to start leveraging, some networks to talk to get some seed money that you know how much you need to get your first milestones, because you did that operating plan, which we talked about earlier.
So I know we're running short on time, so I'm wondering if you guys could leave us all with one parting thought about advisory boards and something you wish you had known before that you do know now. Something either that was good or bad, right, about your advisory board. Maybe Ellington first.
Yeah, I'll dive in. So for me, I wish that I had executed my advisory board earlier. I was really focused on so many other things that it took me time to realize just how, because we had such a stacked group of investors who were so well known and powerful, I kind of thought that I could balance out the need for the advisory board with their credibility, when in reality, you need those key opinion leaders in your industry on your advisory board, continuing to make that network come to life, right? You need, when you can't afford the best CFO, you need to have one of the best CFOs for another company who you're seeking counsel and including them in the growth of your company. Because what I realized was that I was nervous to ask this of people, because I felt like I wasn't giving them really anything in return, right? It wasn't as transactional as everything else that I was looking at. And for me, I had to realize that there are so many people that are out there that are enthused and excited about solving these real world problems and want to get involved and want to experience this with you, that as soon as I started talking about it, or really every conversation that I had that was meaningful with someone who I thought could be a great fit and advisor, and I wish that we had more time to talk about really who you need on your advisory board, but I will say that when you unlock and ask someone to join, the excitement, the enthusiasm, and the willingness to push you forward is really, I think, incredible. And I just wish that I had the courage to ask people sooner, because our advisory board would have been developed, years prior. So it's just, I wish that I'd done it sooner, is really what it comes down to for me.
I would say just quickly, the very important piece of the advisory board that you put together is, once again, what Jesse said earlier: know your blind spots, put people around you that can show you your unknown unknowns. And then I know one of the things that has changed over my career is I went from being a very young know-it-all CEO in my 20s to the idiot CEO in my I just turned 60, but in my late 50s, and and I've really changed my persona to be I don't know anything. And it's amazing when you take that humble please explain to me approach with people, how they jump in and help you and you get way more information. And I've learned so much more than I did when I was that arrogant 20-year-old than I am, trying to be a more humble 60-year-old. So, but I think really critical is look at that profile that you need for those unknown unknowns and get people, surround people. We give a small piece of equity to people that are on our advisory board. We give them some options. So just throw that out there as well.
You hit the nail on the head, Dan. I just want to start there. Humble, hardworking, and hungry is how we hire, and the board should be no exception. We should be no exception. So CEO, you need to practice that. And Dan, man, you have to be willing to make mistakes in front of your team and be willing to show your investors exactly what you don't know. I don't think anybody should expect you to be the smartest person in the room. A good CEO knows their limitations and always has ideally an expert in the room with them or to talk on that. Your job is to manage the resources, create the resources. Know enough to be dangerous, but you don't need to be making every widget or running every business unit. So get comfortable being humble. And to your point, ask questions. I mean, you're going to learn so much more if you just sit back and don't try to have every answer. Nobody wants you to have all the answer. You're going to be wrong half the time. So, I love that you said that. As far as the board, we started early, and I'll say just, in no particular order, don't have more than one lawyer on the board. One is okay. Avoid committees too early, but look, you can't really start too early. The board is there to keep you honest, right? And to give investor confidence in case you get, brain damage, and it happens, trust me, so, how do you fortify this company against yourself? If you're building a good company and you're a good CEO, you insulate it theoretically from any disaster, including you. So how well you're building this has to do with the team that you're building, addressing all your faults, and the bosses that you hire, which are your board. Their job is to look out for the investor money. But to Ellington's best, a great comment just now, you need to find out what motivates them. Their motivation shouldn't be cash. If they're investing because of cash, that's fine, but you don't want them on their board because cash. You want them on their board because of some intrinsic motivation. They see something in you or your team or your company or something that gets them out of bed outside of cash. Ideally, they've been successful enough to be, wealthy enough to spend the time and teach you. And then, the last thing you have to do, and again, it was one of the best things that I did a little late, and I wish I did it early, is ask how they've failed. All their successes. Everybody broadcasts all their wins, and I bet you could recite everybody you knows around you's wins. But do you know how they failed? Our chairman had 5 successful exits. He's infamous and famous in our industry because he's done everything, well and respectfully, but he has had a couple of losses, and that's where we spent a lot of our time. How did that go wrong? You had all the tools and the team and the timing, you still can't fortify against everything. So, asking people about their mistakes, whether you're hiring them as an employee, but also as a board member, you'll learn a lot.
Guys, this is great. I think I see someone trying to pull Ellington to our next meeting. So we're over time. I know we could talk all day about this, but time is money for many people on this panel and attending. So we'll wrap it up there for today, leave everyone hungry for more. Thank you, Jesse, Dan, and Ellington, really for your candor today, for sharing your experience. It's been really interesting and really helpful.
Thank you. Have a great day.
Yeah, you're welcome. All right, everybody take care. Have a great day.